Hello students, welcome to the lecture on fire and motor insurance, and after this lecture we will be able to learn the following objectives. Define the fire insurance and motor insurance, explain the consequential loss policy, understand the policies for stocks. Let's start with the concept of fire and motor insurance. Motor insurance, also known as vehicle or car or auto insurance, is insurance purchased for cars, trucks and other road vehicles. Its primary objective is to provide protection against physical damage resulting from traffic collisions and against liability that could also arise therefrom. Motor insurance in India covers for the loss or damage caused to the automobile or its parts due to natural and man-made calamities. It provides accident cover for individual owners of the vehicle while driving and also for passenger and third-party legal liability.
What is required in Missouri for car insurance? At a minimum, you must have liability coverage. But what's that? If you have an accident and it's your fault, it pays for the injuries or damages you or someone driving your car causes. Missouri requires drivers to carry a minimum amount of liability insurance called 25-50-10. Let's see how this works.
Oh man, of course. Just as soon as I head home from work, it starts raining. Wow, I can't even see the brake lights in front of me.
Oops, too late. Now, how does that 25-50-10 minimum liability insurance work? $25,000 is the most your insurance company will pay for another person's injuries. $50,000 is the maximum amount that will be paid for total injuries caused by your accident. That's it. What about the damages caused in your accident? $10,000 is the maximum amount your insurance will pay for property damages. If you think you need more coverage, then talk to your insurance agent. The second type of insurance required by Missouri is uninsured motorist coverage. This coverage protects you and your passengers when you're injured in an accident with an uninsured driver. Although state law requires minimum coverage, did you know that about 14% of all Missouri drivers are uninsured? So, going back to the accident, what do you do next? Well, the Department of Insurance has got you covered with this awesome free app called RecCheck. It takes you through the crucial steps, from exchanging insurance information to taking photos. The department also has an easy-to-read guide that explains required and optional coverage and provides worksheets to help you shop.
Why motor insurance? Motor insurance third party is compulsory on purchase of new vehicles, whether acquired for commercial or private usage as per Motor Vehicle Act in India. One can be penalized for driving without a valid cover. An accident can happen to anyone, even if the driver of the car is not at fault. This may result into a lot of damages caused in person as well as to the car. Motor insurance turns to be very beneficial under such circumstances. If the driver is liable for an accident which result in bodily injuries to a third party, then the expenses have to be borne by the owner of the car. In such a case, third-party motor insurance saves from a devastating financial blow. Cars are an expensive investment for an individual. An accident can turn this investment into a huge loss as well. Hence, it is important to have motor insurance. It also helps to cover for damages caused other than an accident like fire, theft, etc. What is covered in motor insurance? Motor insurance covers accident caused by external means, man-made calamities such as explosion, burglary, theft, riots and strike, malicious acts, terrorism, etc. Natural calamities like earthquakes, fire, floods, typhoons, hurricanes, storms, cyclones, lightning, etc. While in transit by rail or road, air or waterway. Third-party legal liability cover for an owner driver in case of death. What is not covered in motor insurance? Normal wear and tear of the vehicle due to usage, loss or damage due to depreciation of vehicle. When grocery stores price cucumbers by the piece, customers tend to pick the larger ones first. When the same vegetables are priced by weight, smaller cucumbers tend to be picked first. A tender little cucumber may be a good value by the pound, but not by the piece. This illustrates how different pricing units can affect consumer decision. This explores the feasibility of implementing distance-based motor vehicle insurance. Distance-based pricing converts insurance from a fixed cost into a variable cost with respect to vehicle travel. Distance-based insurance is justified on actuarial grounds, since the more a vehicle is driven, the greater it is chance of having crashes and claims, all else being equal. Distance-based insurance pricing can provide many benefits. Increase actuarial accuracy. It makes premiums more accurately reflect the insurance cost of an individual vehicle. Increase insurance affordability. It offers motorists a new opportunity to save money. Saving could to average INR 2,500 to 5,000 annually per participating vehicle with some system. Let us now discuss the fire insurance. The policies are being sold only by general insurance companies and cannot be sold by life insurance companies. This restriction is imposed only in India but not in other parts of the world. In India also, prior to nationalization, general insurance business was conducted by life insurance companies also, but after nationalization 1972, consequent upon passing of the General Insurance Business Nationalization Act GIBNA, General Insurance Corporation of India was formed and was conferred the exclusive power to regulate and conduct the business of general insurance in India. History of fire insurance. The development of fire insurance can be traced back to 1601 AD, when the Poor Relief Act was passed in England. While this act, letters called briefs, were read from the church asking for collection from the public to help those who suffered losses from fire. There was a great fire in London, a historical disaster in which within span of 3 days from 2nd to 5th September 1666, 80% of the city was destroyed, which showed the seeds of fire insurance as we know it now. Meaning of fire insurance. The term fire in fire insurance is interpreted in the literal and popular sense. There is fire when something burns. In other words, fire means visible flames or actual ignition. Simmering, smoldering are not considered fire in fire insurance. Fire produces heat and light, but either of them alone is not fire. Lightning is not a fire, but if it ignites something, the damage may be due to fire. Under Section 2, Clause 6A, Insurance Act 1938, the fire insurance business is defined as follows. Fire insurance business means the business of effecting otherwise than independently to some other class of business contracts of insurance against loss by or incidental to fire or other occurrence customarily included among the risk insured against in fire insurance policies. Example, the following are the items which can be burned or damaged through fire. Features of fire insurance. The features of fire insurance are as follows. Offer an acceptance. It is a prerequisite to any contract. Similarly, the property will be insured under fire insurance policy after the offer is accepted by the insurance company. Example, a proposal submitted to the insurance company along with premium on 1st January 2011. But the insurance company accepted the proposal on 15 January 2011. The risk is covered from 15 January 2011 and any loss prior to this date will not be covered under fire insurance. Payment of premium. An owner must ensure that the premium is paid well in advance so that the risk can be covered. If the payment is made through check and it is dishonored, then the coverage of risk will not exist. It is as per Section 64 VB of Insurance Act 1938. Utmost good faith. The property owner must disclose all the relevant information to the insurance company while insuring their property. The fire policy shall be voidable in the event of misrepresentation, misdescription or non-disclosure of any material information. Example, the use of building must be disclosed, that is whether the building is used for residential use or manufacturing use, as in both the cases the premium rate will vary. Insurable interest. The fire insurance will be valid only if the person who is insuring the property is owner or having insurable interest in that property. Such interest must exist at the time when loss occurs. It is well known that insurable interest exists not only with the ownership but also as a tenant or bailey or financier. Banks can also have the insurable interest. Payment of premium. Based on the proposal form and the inspection report of the engineers, the insurance company will submit the premium rates to the property owner, and if these rates are acceptable to him, then he should pay the amount to the insurance company. It is also a legal requirement under Section 64 VB if Insurance Act 1938 that the premium is paid in advance in full to the insurance company. Issue of cover note or policy document. On receipt of a completed proposal form and or inception report, the cover note is issued pending preparation of the policy document. The cover note is an unstamped document issued to provide evidence of cover till the time the policy is issued. The cover note provides insurance against specified perils on the usual terms and conditions of the company's policy. The printed policy form provides for a schedule in which the individual details of the contract are typed. The items are similar to those in the cover note but with more detailed information. Procedure to settle the fire insurance claim. If there is any damage or loss arising due to fire, then the policyholder should immediately inform the insurance company in writing and with estimated amount of loss. Survey report. If the amount of loss is small, that is up to INR 20,000, the insurance company may depute an officer to survey the loss and decide on the settlement of the loss on the basis of the claim form and the officer's report. However, in large losses, an independent surveyor duly licensed by the government is appointed to give a report on the loss. The survey report would generally deal with the following matters: cause of loss, extent of loss, under insurance if any, details and value of salvage, and how it has been disposed of or proposed to be disposed of, details of expenses, compliance with policy conditions and warranties, details of other insurance policies on the same property, and the apportionment of the loss and expenses among co-insurances. Special policies. The special policies are as follows. Floater policy. This policy is issued only for the stocks, not for plant and machineries. Sometimes the stock is kept at various locations and it is very difficult to provide the value of stock at each location. Therefore, to cover the risk of stocks at various locations, less than one sum insured and additional premium can be paid. Example, a person is having two god-owns at Delhi and the value of stock is INR 50 lakhs and he is not having the value at each location, then he can insure the stock under floating policy by paying an additional premium. Declaration policies. This type of policy is useful where there are frequent fluctuation in stocks or stock values and to avoid the underinsurance of the stock. Declaration policies can be granted subject to the following condition. The minimum sum insured shall be INR 1 crore. Monthly declaration based on the average of the highest value at risk on each day or highest value on any day of the month shall be submitted by the insured latest by the last day of the succeeding month. If declaration are not received within the specified period, the full sum insured under the policy shall be deemed to have been declared. Reduction in sum insured shall not be allowed under any circumstances. It is not permissible to issue declaration policy in respect of insurance required for a short period, stocks undergoing process, stocks at railway sidings. Floater declaration policy. It is combination of the mentioned policies, that is stock lying at different location and the value of stock fluctuating. Declaration policies. This type of policy is useful where there are frequent fluctuation in stocks or stock values and to avoid the underinsurance can be granted subject to the following condition. The minimum sum insured shall be INR 1 crore monthly. Declarations based on the average of the highest value at risk on each day or highest value on any day of the month shall be submitted by the insured latest by the last day of the succeeding month. If declarations are not received within the specified period, the full sum insured under the policy shall be deemed to have been declared. Now moving on to the next topic, we will study the motor insurance. Motor insurance gives protection to the vehicle owner against damages to his or her vehicle, pays for any third-party liability determined as per law against the owner of the vehicle. Third-party insurance is a statutory requirement. The owner of the vehicle is legally liable for any injury or damage to third-party life or property caused by or arising out of the use of the vehicle in a public place. Driving a motor vehicle without insurance in a public place is a punishable offence in terms of the Motor Vehicles Act 1988. Types of motor insurance cover. There are the types of motor insurance available in the market. Car insurance policy can be broadly classified as follows. Private car insurance. It is compulsory for all the new cars to have motor car insurance. It is insurance for vehicles not used for commercial purposes. The amount of premium depends on the make and value of the car, state where the car was registered, and the year of manufactured. Commercial vehicle insurance. It provides cover for all the vehicles which are not used for personal purposes, goods carrying vehicles like the trucks, tempos and HMVs. Comprehensive insurance policy. This type of plan has a wider scope and covers all the mentioned liability along with the insured person's damage, theft, expenses and injuries in result of an accident of the auto vehicle. This type of policy can be extended to increase benefits as an additional feature. Policy forms. Policies insuring motor vehicles are to be issued only as per the standard form given in Section 6 of the Indian Motor Tariff. Types of policies. There are two types of policies. Liability only policy. This covers third-party liability for bodily injury or death and property damage. Personal accident cover for owner, driver is also included. Package policy. This covers loss or damage to the vehicle insured. Restricting the scope of cover under Section 1 of the package policy without any reduction in tariff rates is permitted. Excepting this, no alteration or extension of any of the covers, terms, conditions, exclusion, etc. of any of the policies or endorsement laid down in this tariff is permitted without prior approval of the TAC. Insurance not provided for motor insurance in India cannot be transacted outside the purview of the India Motor Tariff unless specifically authorized by the TAC. For risks which have not been provided for in the tariff, reference should be made to TAC for advice thereon. Insured Declared Value IDV. The insured declared value IDV of the vehicle will be deemed to be the sum insured for the purpose of this tariff, and it will be fixed at the commencement of each policy period for each insured vehicle. The IDV of the vehicle is to be fixed on the basis of manufacturer's listed selling price of the brand and model as the vehicle proposed for insurance at the commencement of insurance or renewal, and adjusted for depreciation as per schedule specified. The IDV of the sidecar and or accessories, if any, fitted to the vehicle but not included in the manufacturer's listed selling price of the vehicle is also likewise to be fixed. Period of insurance. Unless specifically stated otherwise, premiums quoted in the schedules under various sections of the India Motor Tariff are the premiums payable on policies issued or renewed for a period of 12 months. No policy is permitted to be issued or renewed for any period longer than 12 months. Transfers. On transfer of ownership, the liability only cover either under a liability only policy or under a package policy is deemed to have been transferred in favor of the person to whom the motor vehicle is transferred with effect from the date of transfer. Personal accident covers for owner driver. Subject otherwise to the terms, exceptions, condition and limitation of this policy, the company undertakes to pay compensation as per the following scale for bodily injury or death sustained by the owner driver of the vehicle in direct connection with the vehicle insured or whilst mounting into, dismounting from or travelling in the insured vehicle as a co-driver caused by violent, accidental, external and visible means which independent of any other cause shall within 6 calendar months of such injury result in provided always that the compensation shall be payable under only one of the items. 2. In respect of the owner driver arising out of any one occurrence, and the total liability of the insurer shall not in the aggregate exceed the sum of INR 1 lakh during any one period of insurance. Let's know the meaning of consequential loss policy. Generally, insurance policies cover only physical damage to property by insured perils. This at best covers the expenses incurred for repairing or replacing the damaged property. But what about the financial loss suffered due to interruption of business operation whilst the damaged property is being repaired or replaced? This policy offers a solution by covering profit loss due to reduction in turnover arising from interruption of business following damage to the property insured. How to select the sum insured? The sum insured under CL policy, consequential loss, should represent the gross profit of the indemnity period selected. The indemnity period is the maximum period required to put the business back into normal operation after damage to insured property by an insured peril. The indemnity period could vary from 6 months to 3 years. As Indian stock market is one of the most volatile stock market in the world, as the as the number of private corporations are growing day by day and financial markets becoming more developed, they need of the study of different policy implication by corporate sector. There are a number of studies existing on the determinants of dividends behavior in Indian context. All the studies have determined the dividend behavior from the perspective of the factors influencing the dividend behavior in the short run as well as in the long run. But a very few literature captures the intricacies of market reaction to the dividend announcement by Indian corporate sector. Inactive client account. Client account will be considered as inactive if the client does not trade for a period of 1 year. Calculation will be done at the beginning of every month, and those clients who have not traded even a single time will be considered as inactive. The shares, credit, ledger balance, if any, will be transferred to the client within 1 week of identifying the client as inactive. The client has to make written requests for reactivation of the account. Now in the end, let us summarize what we have learned in this lecture. Distance-based pricing provides a marginal financial incentive to reduce mileage, allowing individual consumer decide which miles. The motorist reduce mileage and therefore crashes and insurance claims. The saving that results are net benefits to society, not just economic transfer. The policies are being sold only by general insurance companies and cannot be sold by life insurance companies. The term fire in the fire insurance is interpreted in the literal and popular sense. Floater policy is issued only for the stock, not for plant machineries.